Hello, in this lecture we'll be covering bookkeeping. We'll cover basic journal entries as well as adjusting journal entries. First of all, it's important to note that there are four major financial statements. This includes the balance sheet, the income statement, the owner's equity statement, and the cash flow statement. All of these statements are based off of journal entries, so it's very important to get them right. On this slide, you'll see normal balances and account names. You can see that there are five general classes of accounts: assets, liabilities, and equity, which go on the balance sheet, as well as revenue and expenses, which go on the income statement. You'll also see that an account has two sides, a debit and a credit side. One of these is the normal balance of an account. The normal balance is simply the side of an account which it normally increases on. So for an asset, its normal balance is a debit balance, which means it increases the debit side. For a liability, the normal balance is a credit balance. This means liabilities increase on the credit side. These balances form the key for bookkeeping, so it's very important to get them right. Let's look at an example. Let's say we've got someone named Dave Smith. Let's say that Dave invests $100 of his own cash into his business. Well, what happens here? Well, if we think of the transaction, we know that the business is gaining cash. And because cash is an asset, assets must increase. So if we look on the chart below, you'll notice that to increase an asset, you have to debit it, which is why we debit cash for $100. However, we've also got to account for the credit balance. And we know that when a business gets money, that forms its equity. And to increase equity, we'll have to credit it. So if we look at the chart on the bottom, we can see that to increase equity, we have to credit it. And right here, we credit the equity account. It's pretty simple. Let's look at another example. Let's say Dave Smith brought supplies for $200. In this case, the business is gaining an asset. The asset are supplies, which can be used for whatever purpose the business wants. Of course, we have to increase the supplies balance. And to increase the supplies balance, this asset balance, we've got to debit the asset. We've also got supplies, but we've given up cash. And we've given up $200 worth of cash. This means we have to decrease an asset. And as you can see on our chart, to decrease an asset, you have to credit the asset. That's why we're crediting the cash balance. First of all, we increased our supplies by debiting supplies for $200, and then we decreased our cash because our cash balance went down. Let's look at another example. Let's say Dave Smith incurs $300 in utilities expense. In this case, we're not dealing with just an asset, we're dealing with an expense as well. So we know that he has to pay the utility company $300. Therefore, we've got an expense. To increase an expense, to recognize the expense, we have to go on its normal balance. The normal balance of an expense is a debit balance. So to increase an expense, we debit the expense. You can see right here. We debit the expense of utilities expense for $300, and we credit cash for $300 because we're giving up an asset. We're decreasing our asset, which is cash. Fairly simple. Let's look at another example. Let's say Dave Smith sells $400 materials to a customer and receives payment immediately. So in this case, we've received cash, right? We've received cash, which is an asset. So once again, we're going to debit cash because we're trying to increase our cash balance. At the same time, we're going to credit revenue because this time you've received the cash, but it doesn't go into equity right away. It's revenue. It's money that the business earns from selling materials, goods, services. In this case, it's materials. Therefore, it's revenue because it's something the business earned from selling goods and services. So to increase revenue of $400, we have to credit it. We credit revenue to increase revenue. What we see right here. Let's move on to another example. Let's say Dave Smith purchases marketing pamphlets for $500 on credit with payment due in 10 days. This means he basically ordered pamphlets and he promised he would pay 10 days later. So, again, we're dealing with an expense. The first thing that we have to know is that, okay, we have to recognize that there is a marketing expense that he's incurred. To increase an expense, you debit it. You debit an expense, but at the same time, you have an obligation to make the payment in 10 days. To fulfill this obligation, it's a legal obligation. It's a liability. So to recognize that liability, to increase that liability, you're going to have to increase the liability account, which, if we can see from our chart, is simply to credit it. So we credit accounts payable for $500. Now, those were some of the basic entries. We're going to move on to adjusting entries now. They're slightly more complex. So let's get to it. The first example will be a rent example. Let's say Dave Smith pays $600 of rent on July 1st. And this will just be for the month of July. So he pays $600 of rent on July 1st. So he recognizes a prepaid rent account in which he debits it for $600. And then, since he's paid money, he's paid cash, he's going to credit cash for $600 because that's how much cash has gone out of the company. On July 31st, however, he no longer has legal rights to the land. Therefore, that prepaid rent is no longer prepaid. It's been used up. So you have to de-recognize it. So to decrease an asset, you credit it. But now that rent, since he's used it up, it's considered an expense. So he has to debit that expense. So you can think of prepaid rent as a temporary asset that later transforms into an expense. And that's exactly what happened here. He prepaid rent for $600. It was an asset on July 1st because it gave him rights to land, which was used to produce business, to rent office space, right? And later, at the end of the month, it was no longer prepaid because the time limit's up. Therefore, it becomes an expense. Let's look at another rent example. Let's say Dave Smith pays $700 of rent on July 1st, but this time it covers 2 months, July and August. So the entry we make on July 1st is going to be the same as the one in the previous example. We're going to debit prepaid rent for $700, and we're going to credit cash for $700. However, on July 31st, we don't de-recognize the $700 right away. We only de-recognize half of it. Because we're prepaying the rent in advance for 2 months, we can prorate it based on time. In this case, since 1 month is up, only half the prepaid rent can be considered used up. That's why we're crediting prepaid rent for $350 and debiting rent expense for $350. Only half of that prepaid rent is converted to a rent expense. Then August 31st, the same thing happens. The remaining prepaid rent gets used up and becomes rent expense. So we credit prepaid rent and we debit rent expense. And you can think of prepaid rent as something that's prorated over time and changes as time goes on and becomes an expense. Let's look at another adjusting entry. In this case, an advance from customers. Let's say Dave Smith receives $800 from a customer on September 1st for goods that he promises to deliver on September 30th. In other words, a customer pays him $800 and Dave Smith says, all right, I'll promise to deliver you the items on September 30th. So what happens? Well, on September 1st, he debits cash because he's receiving $800 of cash. However, as time goes on, things will change. And we're not recognizing this as revenue yet because he hasn't delivered the item, so it's not considered revenue. So instead, he sets up another account called Advances from Customers. Advances from Customers is a liability account. He has an obligation to deliver the goods worth $800. Even though he received cash worth $800, he's still legally obligated to deliver the goods to the customer. Therefore, he recognizes a liability called Advances from Customers for $800. On September 30th, he delivers the goods. So the first thing that he can do is he can get rid of Advances from Customers account. The liability is no longer a liability because he's fulfilled his end of the bargain, and he simply debits advances from customers to get rid of it. And this time, since the goods have been delivered, revenue is considered earned and you can credit revenue for $800. Again, revenue is recognized when earned under accrual accounting. Let's look at payment at a later date. Let's say Dave Smith buys supplies for $900 on account on January 1st and pays the balance on January 10th. In other words, he's buying supplies and then saying that he'll pay later. Okay. So on January 1st, his business has received supplies, which could be goods for whatever purpose. Therefore, to increase an asset account, you debit supplies for $900, but he has a legal obligation to make a payment in the future. And what do you do in this case? Well, you simply credit accounts payable for $900. And later on January 10th, when he does make the payment, that legal obligation of accounts payable is gone. So you de-recognize accounts payable by decreasing the liability by debiting accounts payable for $900, and you credit cash for $900. In this case, on January 10th, you're decreasing the liability and decreasing an asset, because on January 10th, you're paying the $900 of balance, you're giving up $900 of cash. Let's look at another adjusting entry, salaries and wages. Let's say Dave Smith owes his employees $1,000 on January 1st, and he pays them, and he will pay them on January 10th. So on January 1st, the entries we'll make is we're going to recognize that we've got salaries and wages expenses worth $1,000. We can recognize this expense because it's been accrued. We realize, we recognize it. We know that we have to pay them $1,000. But we also know that we're not going to pay them on January 1st. We're going to pay them on January 10th. So for now, they're a legal obligation, which means they are a payable. Salaries and wages payable, and to increase a liability and obligation, you credit it. We also know that finally on January 10th, the payment is made. So the first thing that happens is that the payable is eliminated. So we simply make the opposite entry, which means we debit salaries and wages payable and de-recognize that account. However, we also are making a payment with cash. So we're going to credit cash for $1,000 because we've made the payment. And we've given up $1,000 of cash. So we're crediting the asset balance. We're decreasing an asset, in this case cash. And we do that by crediting cash. Let's look at another example. In this case, we're talking about a collection of cash. Let's say Dave Smith delivers goods to a customer on January 1st. The customer pays $1,100 on January 10th. In this case, it's slightly different from the earlier scenarios. In this case, the customer has a legal obligation to pay us $1,100 on January 10th. So we can recognize an accounts receivable, an asset account. An accounts receivable is basically a promise that a customer is going to pay you in the future, in this case for $1,100. And in this case, since we've fulfilled our end of the bargain, we can recognize revenue of $1,100 on January 1st. On January 10th, when the customer does pay you cash, you debit cash because your asset balance went up, and to increase an asset account, you debit it, and you credit accounts receivable because the customer is no longer obligated to pay you $1,100. The customer's already done that. To decrease an asset account, you credit it. Let's look at another example. Let's look at an adjusting entry for depreciation. Let's say Dave Smith buys machinery for $1,200 on January 1st. The machinery has a useful life of 1 year using straight line depreciation and a salvage value of 0. So on January 1st, what do? Well, we know we buy machinery, an asset for $1,200, simply debit it. We're paying it with cash, so we pay cash again for $1,200 and we credit it. Fairly simple. Now, we know that we're using straight line depreciation here. And under straight line depreciation, what we have to know is the formula for straight line depreciation is the cost of the asset minus its salvage value divided by its useful life to get depreciation per month. So depreciation per month will be $1,200 divided by 12 months, which equals $100 per month. Since our salvage value is 0, 1,200 minus 0 is going to equal 1,200. So on January 31st, we're going to have depreciation expense of $100 on this machinery because $100, the machinery is worth $100 less now. And we're going to credit accumulated depreciation for $100. Now, accumulated depreciation is not a liability account. Accumulated depreciation is a contra asset account. In other words, accumulated depreciation is an asset account with a normal credit balance. Normally, asset accounts have a normal debit balance, but in this case, accumulated depreciation is a slightly different account. So that's important to know, and that's the entry we make. Let's look at one more example. Let's say we've got an entry for usage of supplies. Let's say Dave Smith buys supplies on January 1st for $1,300 and finds out at the end of the month he only has $200 of supplies left. What's the entry in this case? Well, we know he started off with 1,300 supplies, and we know at the end of the month he only had 200 supplies left. This implies that he used up $1,100 worth of supplies. So on January 1st, when he buys the supplies, what do? Well, we typically, what we do is we simply recognize that he's got supplies. So we debit supplies for $1,300, and he's paid cash of $1,300, so we credit cash for $1,300. On January 31st, what do? Well, we know that he used up $1,100 of supplies. $1,100 supplies were used up. So what do we do in this case? Well, we basically recognize supplies expense for $1,100 because it's an expense we incurred in using up the supplies. Supplies were an expense of running the business, and the supplies have gone down by $1,100. Therefore, $200 supplies are left. We started off on January 1st with a debit balance of $1,300 in supplies, and we ended January with a credit balance of $1,100 in supplies. The difference is a debit balance of $200 in supplies. Let's look at one last example. Let's look at insurance expense. Let's say Dave Smith pays $1,400 for 1 year's insurance coverage on January 1st, 2021. So in this case, just like prepaid rent, we're going to recognize prepaid insurance for $1,400. He's paid cash for $1,400, so we credit cash. Debit prepaid insurance, credit cash. And just like before, that prepaid insurance on January 1st, 2022 will turn into an expense. So on January 1st, 2022, you recognize insurance expense and you credit prepaid insurance to get rid of it. Essentially, that's all you do. I hope you guys enjoyed this lecture. Thanks for watching. Make sure to subscribe.